The Oahu real estate market report for October 2022 is out. The Fed's inflation battle is the main talking point, as inflation numbers have stayed high and the Fed raised the Fed's fund rate 0.75%. The Fed has announced they will continue to be aggressive with getting inflation under control. So in this video, I'll go over what is happening in the Oahu real estate market and what you should expect moving forward. Coming up next. Hi, I'm Scott Startzman with the High Estates team and 20-year Oahu realtor. Inflation numbers stayed hot as reported early last month with over 8% inflation for the year. The Fed's target is 2%. The jobs report was hot as well. So in doing so, the Fed raised the Fed funds rate, and all this should trickle down to mortgage interest rates as they continue their rise. The idea is to try to increase interest rates to deter consumer spending to get inflation under control. Though there is a lag on this effect and it takes time to kick in and inflation has stayed stubbornly high, the Fed is going to stay aggressive in what they're doing to try to curb inflation. So let's take a look at what the Oahu housing market is doing right now from nearly 9 months of the Fed's action to curb inflation, and then I'll explain what I expect to happen moving forward. As we see on this slide, the median single-family home price for a home in October 2022 was $1,050,000. That's up 5% from the same time last year, and last year was a red-hot market. So there still is momentum in the market, though we've decelerated significantly, and I do expect us to start to trend sideways moving forward. If we look at the number of closed sales, we're down 41.7% in the number of sales that have occurred this month compared to the same time last year. This is a direct effect of what the Fed has been doing to try to curb inflation and raising the Fed funds rate. It's trickled down to mortgage interest rates. Mortgage interest rates at the beginning of the year were right around 3%. They're now over 7% for a 30-year mortgage. In doing so, that's affected buyer affordability. Anybody that's looking to get a mortgage is significantly affected by that rise in interest rates. So therefore, there are fewer buyers in the market, and thus we're having a significant drop in the number of sales. The median number of days on market for a single family home right now is 19 days. That's still pretty quick and still fast moving considering the deceleration that we've had in the marketplace. However, we are up off of our historic lows of 9 days on the market. So on this slide, what we'll actually see is some of that effect of what the Federal Reserve is doing and where interest rates have gone. We have 656 active listings on the market. That's still severely restricted in comparison to where we were pre-COVID dates. Prior to COVID in 2019, the month with the lowest number of active listings on the market was 1,621 homes. And in that market, we had a 6% price appreciation. In 2005, 2006 market, at a height when we had 25% appreciation, we had 814 homes on the market. So our inventory is significantly restricted. There are not a lot of choices that are on the market right now. And this is also a direct effect of what the Fed is doing with trying to curb inflation. Any potential seller that had a mortgage at 2.5% or 3% and they have been thinking of selling, they're going to hold off now, or they're going to have reservations of selling that home that had that low mortgage interest rate and buying a new home with an over 7% mortgage interest rate. So what it's going to do is keep more potential sellers in place, not bringing their home on the market. Therefore, we're going to continue to have restricted inventory. What we're seeing is sellers are on average getting 99.8% of what they're listing their home for. And in doing so as well, 36.5% of the properties are selling over the asking price. That means in a market where we're having 41% fewer sales, 1 in 3 are still selling over the asking price. So there's still competition in the market, even though there's far fewer buyers in the market. It also means there's far fewer sellers in the market, and our new listings coming on the market are off by over 25%. If we look at the condo market, the median sales price for a condo in October of 2022 was $520,000. That's up 4% from the same time last year. If we look at closed sales, sales are off 28.8% from the same time last year. So we see the same deceleration in the condo market as we do in the single family home market. And if we look at the median number of days on market, or the time that when the seller brings on their home to put it on the market to when it goes into escrow, we're at 19 days. That's up off of our historic lows, but 19 days is still relatively fast moving. So if we look at the condo side, we're seeing the same effect that the Fed is having on the single family home side, which we have 1,194 active listings for sale right now. If we look at pre-pandemic, the month with the lowest number of active listings for sale in 2019 was 2,400 condos for sale. So we still have very restricted inventory on the condo side as well. That's a direct correlation to what interest rates have been doing. People with that low mortgage interest rate are going to stay in place rather than selling and buying another condo or another home with an over 7% mortgage. In doing so, what we're seeing is sellers are getting on average 99% of what their list price is, and 30% of the condos coming on the market are being bid up over the asking price. So all in both the single family home and the condo market, we have restricted inventory. We have way fewer buyers in the market. Fewer sales are transacting, but because of the restricted inventory, we're still seeing some competition and some strength in the marketplace. What we are going to see is neighborhood-specific market performance. What I mean by this is neighborhoods that have a buyer demographic that depends more heavily on low down payment programs and high balance mortgage options, meaning low down financing options like VA, FHA, USDA loans, will experience more of a pullback on prices than those neighborhoods where a significant number of buyers are paying cash. For example, the Eva Beach and Kapolei areas see low down loan programs making up roughly 80% of the type of loans for buyers in those neighborhoods. These are buyers that are more impacted by interest rates. Therefore, I expect this area to be more interest rate sensitive when it comes to prices. On the flip side of that coin is Kahala and Diamond Head, where 60 to 65% of the sales are to cash buyers. This area will hold its value and be less sensitive to interest rate increases. In other words, the gap between the haves and the have-nots in terms of money and wealth will widen during the next year or so, as the people with cash will be able to have the best chance at opportunities that come up. Thanks for watching this video. Once again, I'm Scott Startzman with the High Estates team and 20-year Oahu Realtor. If you have any Oahu real estate needs, we'd be happy to help. You can call, text, or email anytime. Reach out. We'd love to help.